Hello, welcome to another webinar with Arnold and Moat Wealth Management. I'm Nick Ford, and I'll be talking to you today about some of the mind games we play, thinking that we can outsmart the market and timing, and just think that we can do things that in reality we can't. The title of this is one of the common types of things that we hear clients say sometimes: buy more of the winners and sell all of the losers. Seems really simple, doesn't it? But it's not. And so this is where we will talk about fighting our worst instincts with real numbers. I'll go through some of what we tend to think we can do, but counter that with some real numbers from the past 25 years and see where in reality we might actually fall. So start with human nature. It really can be our own worst enemy. I'll outline a few of the things that we tend to think. So short-term thinking is driven by constant headlines. This is being recorded in April of 2025, which is probably one of the worst time frames that I've seen for headlines. Just constant, incessant headlines. In this case, it's a lot about tariffs coming into play, stagflation, inflation, just all the different buzzwords are just kind of thrown into one bowl and just mixed up and spoon-fed to us every day, whether it's on television, radio, social media, everything. And all these things take our long-term thinking and just with every headline, just keep shrinking down, shrinking down, shrinking down until we're not even looking a week ahead. Honestly, we're looking minutes or hours ahead when we're really sucked in to what we're seeing and looking at today. Fear of failure and the unknown really do rule our decision making if we let it. Now, this could be fear of failure, could also be just a fear of loss. And when things are unknown, we don't know what will happen. That's when we start to panic, literally and figuratively, on what we should do. And usually we're just afraid, but let's just get out. Let's just sell these assets. I don't know what's going to happen. I'm afraid. And that makes sense. That again, that's human nature. When we are afraid of something, we tend to want to back away. So we need to avoid our lizard brain taking over and think through what is the logical long-term course of action. Last one here, recency bias. So this fuels greed and makes us want to just double down on the winners. So recency bias, we're not thinking as far back for information as we can or should. We're looking at what's happened lately and making that the new basis of our decisions. Basically thinking, well, this happened most recently. This is what will always happen from now moving forward. And we get greedy because we see, oh, what's been a winner, whether it's a certain stock like a Tesla or Nvidia, and we just think, well, how could it possibly go down? We need to get even more of this and keep this momentum going. Again, not always the case and not usually the case. This time is different. There's a common one. Like, I know all these things. I know, but this time is different. You hear that said, we tell ourselves that a lot as well. So this slide will look at some of the conflicts, some of the confusion we make. We're looking at immediate returns, but that's in conflict with our risk tolerance that we have for taking on different issues and thinking about what we're willing to handle and tolerate on behalf of what the rewards should be. So the risks of volatility are easily forgotten when things are good. Really, for a lot of the last decade, or even 15 years, with the exception of, say, the COVID crash, which was very quick and back in place, and a few, not even recessions, just more natural cyclical downturns, we just think, well, it always goes up and to the right when we're looking at our accounts and how they do. And we forget that, hey, there are risks and there is volatility. if we expect anything beyond the return of just cash in a bank account. So it's a little bit of a cake. We want our cake and eat it too. We want the high rewards, but we just become shocked if there could be any volatility and oh, it's down a little bit. Well, what's going on? What's broken right now? This comes up with the question below, why do we even have any bonds? We've heard this a little bit the last 4 or 5 years. And obviously, bonds have not performed as well recently when interest rates rose so quickly. But we forget that the whole purpose of bonds is not for the return they provide, it's for dampening the volatility and keeping things more stable, which, especially if you're in the middle of retirement, there's some value to that, right? Another item here, long-term goals are achieved over years, but can be sabotaged in a day. When people are trying to time the market and say, all right, let's get out now, I'm a little worried. A lot of times when you do have a bit of a downturn, it comes back up extremely quickly. And if you're decided to sit on the sideline, you're likely missing that, and you might miss the majority of the upside just by being out a little bit. Again, here's the quote. I'll just get back in the market when it's at the bottom. Of course, you don't know when that bottom is going to be, and usually it's back up before you've had a chance to react. So rebalancing often feels counterintuitive when in your mind you're just thinking, okay, let's get more of the winners. Why don't we just have more of these winners and sell the losers? But rebalancing is about continuing to stay within your risk tolerance, not about maximizing your returns. So, so obviously rebalancing, you're selling some of the winners and buying some of the losers because you're trying to stay within a certain range of allocations. Yep, I don't see how Tesla could ever go down. So why would we ever sell it when it's up? Hear this fairly frequently. Maybe not about Tesla, but about other certain stocks or certain categories. So now we get to trying to counter some of these mental arguments we have with ourselves. What do historical numbers say? In order to do this, we've done an exercise using a website, a blog that we feel is very common sense oriented, obviously, because the title is A Wealth of Common Sense. Ben Carlson has this site and writes some very excellent articles that are good at countering some of these things and just looking at it with real numbers, logic, and a very objective nature. On the left side of this screen, you'll see what we call an asset quilt or asset blanket, you might hear it called too. This will look back in time. In this case, it's usually a 10-year look back, and it's looking at certain asset categories. So it has US large cap stocks, international stocks, emerging markets, commodities, cash, treasury, inflation protected securities, all this range. And it's saying, okay, in this given year, what is the annual return on this in this year? So on the left side here is 2015. So from January 1st through December 31st, what's the percentage return? And each category is color coded, so you can see how it's kind of like a checkered pattern. One given category is the top, and then the bottom and the middle bouncing all around. That's what gives it a quilt appearance. So the goal of this is to see, okay, over time, how is this checkered? What do things look like? And you can see the individual percentages that do apply. In this case, it's 2015 through 2024, and then on the very right-hand side is the whole 10 years, annualizing the total return over that time and ranking the highest return at the top, the lowest at the bottom, everything dropping down numerically. I will emphasize also, so EW is equal weight. So that's just saying, okay, of the whole, if you have the same amount in each of these categories over time, here's what the kind of the average or equal weighted portfolio would look like with everything combined. And also, this is based on certain, usually ETFs or mutual funds. It's listed at the bottom in smaller print on the asset quilt. So it's tracking certain ETFs that are designed to really represent each of these categories. So looking at how we try to go through this, we're taking the asset quilts all the way from the year 2000 through 2024 results, which gives us a 25-year track record of basically the same funds or equivalents, tracking the same asset allocations, and we're applying over time. So in this case, this is just an example of a spreadsheet used that's equal weight with annual rebalancing. So it resets. So it's the same allocation every time. You just keep going through. You see, we go through every year through, and you get to what the final amount is. In this case, okay, so we started with $10,000 on the upper left side. Bottom right here, it ends up at $48,000. Again, this is not inflation adjusted. These are just in future dollars, what it ends up with if you did nothing other than just, continue rebalancing, keeping it equal weight over time every year. So just to give you guys, and this is summarizing the annual gain for each year in dollars and percentage. And then at the bottom left, you see the different categories, just to give some highlights of, okay, what was the highest return in a year, the average, lowest, standard deviation, which is a measure of volatility, and CAGR is the compound annual growth rate. So it's just annualizing the results over time. So here's an example. This is the asset quilt we saw previously, 2015 through 2024. Now, pointed out, obviously, US large cap growth has been very high the last 10 years. So you can see 5 of the last 10 years, it was the highest return category of everything here. So again, 13%. And I'll highlight one other one here. Emerging markets, you see the blue arrow. So the emerging markets were lower. We're comparing 13% versus 2.9% annualized return over the last 10 years. So end of 2024 going back through 2015. Now, I'm going to go back to the recency bias point. We're thinking, okay, why would maybe we shouldn't even invest in anything except US large cap. Look at how it's done in the last 10 years. Why would it be any different the next 10 years? Well, I'll show you why it very well could be different. So let's look back here at 2000 through 2009. This is the asset quilt from that period. And let's look at something. Oh, wow, large cap, the US large cap, instead of the best performing, it was the worst performing. In fact, it was actually negative. So if you had $10,000 invested in US large cap starting in 2000, on average, you would have lost 1% every year over that time. And how about emerging markets that didn't do so great over the past decade? Well, look at there, second highest, 9.5% annualized return over that same time. So the important thing is remember, there's no guarantee. And just looking at these 2 asset quilts shows how different one decade can be from another one. So if you're all in on one category and everything allocated to it, you could come out well ahead, but you could just easily be slapping your forehead in 10 years and saying, man, why did I do that? Here's some numbers by category here. So again, the asset quilt is in all the different categories. You'll see on the left-hand side, each type. So REITs, or real estate investment trusts, that was actually the highest. And this is looking over all 25 years. So January 1st, 2000 through December 31st, 2024, had the highest compound annualized growth rate here, almost 10%. And it goes down through here. And I'll make some observations. So first off, the US large cap stocks, they weren't the highest over the last 25 years. In fact, they underperformed both US small cap and US mid cap stocks by a decent margin here, 2% lower than annualized over below the small cap, which 2% when you're taking it over 25 years, that adds up quite a bit of difference. Also point out, so the international and emerging market stocks, they were more middling here. They weren't the worst, but they definitely weren't as high as the US in this case. Also had a little bit higher volatility. So looking at the standard deviation column. And another note, you'll hear people talk about commodities, especially maybe right now would be gold. Oh, you should be in gold. You should be in, could be ag type commodities, whatever might be kind of the flavor of the month. But look at the difference here. Commodities was basically no better than cash over the entire 25 years. But look at the standard deviation or the volatility, 22% versus less than 2%. So you can have much more consistent, less volatile return or experience with cash than the commodities. So I just want to remind you, commodities are really more of a speculation and timing type thing. We don't consider them an investment category like we do other categories, the equities and bonds in particular. Again, here's the definitions for both of these categories. Okay, so now we're going to look, again, think back to the spreadsheet that I showed you earlier. All those results, we're able to make changes in the spreadsheet to recognize certain types of categories. The one you saw was more of an equal weighting, which we're reflecting here. So we're comparing a few different things here. So equal weight, this includes all the asset classes equally in the Ben Carlson asset quilt chart. So the end of each year, the winner gets the allocation from the loser during the next year. So this is the case where in the third row here, the winner doubles and the loser sits out. So this goes back to the title of our webinar today. Just basically just get more of the winners and sell the losers. This is what we're doing that. Whatever the winner was doubles in its allocation the following year, and the loser sits out. So there's nothing allocated to the loser. So let's say in the year 2000, REITs were the loser. That means in 2001, we have no REITs, and that portion goes to the what was the winner in 2000. So going without rebalancing usually results in more volatility over time just because you're drifting off target. So this should not be surprising. If you're getting, because over time, so stocks and REITs in this case, the stocks are going to do better. Even though you have your down years, over time, it's a higher amount. So this means that the portfolio, if you do not rebalance over time, will get more aggressive, which means it'll probably return more, but it'll also have more volatility. So this is a good example where the standard deviation is the highest at 11.151% when you're doubling the winner, which is probably a stock type category. But in this case, you actually have the worst performance. So if you thought you were being clever, being smart, going all in on the winners, selling the losers each year, you're actually creating more work for yourself, creating more volatility, and getting a lower return. Again, just in this circumstance. So again, do not outsmart yourself. So yes, typically lower total return than doing no rebalancing. So now let's change. So we're only using a portion of all the categories in the asset quilt now. We're only looking at what we would consider an 80-20 portfolio, which means 80% stocks, 20% bonds. This means we're not including commodities or cash, real estate investment trusts. So we're narrowing down, in this case, on the left side, you see the 80-20 portfolio construction, different percentages totaling up to 100% between 5 different categories from the quilt. So what are our takeaways? In this case, so the first row is with annual rebalancing. So every year we're getting back to our percentages on the left-hand side. Then the second row is if we never did any rebalancing. We just start with the 80-20 and just let it grow however it's going to over time. The third row, it's 80-20, it's rebalancing, but with 5% of the portfolio basically going from the loser into the winner for the next year. So it's skewed slightly. And the fourth row, we're taking 10% of the portfolio and taking from 2 losers, so the 2 biggest losers to the 2 biggest winners for the following year. And we do that, repeat that every year, just keep shifting and shifting. So obviously, number one, it would take a lot more work and time to just keep up and redo that every time. And it also, again, you're going all in on the winners here. So both the bottom 2 options, again, have 5 or 10% going from the loser to the winner for 1 year. The regular rebalancing in this case, sits in the middle of these two, which is interesting. So in this case, the as far as return is concerned, your lowest return is when you're doing the 10% shifting between losers and winners. Then your rebalancing sits between that and doing 5%. So you're basically not getting any defined benefit by doing this extra work, and you're also the standard deviation isn't really not changing too much either. It's interesting. In this case, actually, you had a little higher, the highest standard deviation when you were doing the annual rebalancing, but not too much higher in this case. All right, now 60/40 portfolio. It's the same premise as the 80/20, except it's a little more conservative. So instead of 20% portfolio in bonds, it'll be 40%. This is, I would say, the most typical portfolio allocation that we would see for retirees or someone just entering retirement. It's kind of the classic mix that you would hear described in most analysis of investments for just kind of your regular person doing this. So same format, we have the annual rebalancing at the top, no rebalancing second, and then the 5% and 10% shifts from losers to winners in the bottom two rows. So in this case, again, the regular rebalancing sits between the two, the 5% and the 10% for return. Little variation there. And in this case, you actually have the highest volatility with the lowest return when you're trying to do 5%. You're taking some from the biggest loser and giving to the biggest winner each year. So again, you're going through extra work. You think we're going to juice the return here. You're really no guarantee of doing that, even though you think so. You do have a higher return by not rebalancing, but again, that's just because you're skewing more and more towards the stocks and less towards the bonds over time. So you're drifting from what your target really is. Now let's look at this a little bit more in terms of market timing. I find this really interesting. So looking back over the last 25 years, we have certain years that were obviously bad years, some worse than others. So the premise of this exercise is to say, okay, so in the first year in this, we had 2002 was a bad year. You remember that's kind of a tech bubble type situation. So 2002 was down, and then 2003, the market was coming back. But we don't usually do a good job at nailing that. We're usually delayed. So in this assumption, we're taking each of these bad years, which in this case would be 2002, 2008, 2018, 2022. So those four. We're not including COVID because that was such a quick down and back up. We're just going to leave that out. But a lot of people kind of got themselves messed up from that too. So we're not even including that. And we're saying, all right, it was a bad year, bad year. You actually sat out the following year because it took you a little bit to say, all right, now I'm getting out and I'm going to take a bit before I get back in. So this is only 4 years of the last 25. And that's shown in each of these rows. Each of these rows. So if you did no change, you just stuck with it, which is what we typically recommend. Stick with it is the no change row across all of these situations. Then we have, okay, it's just 1 year that you happen to sit out, but then you didn't do it any other time. So 2003, 9, 19, 23, and then some combinations of a couple of the years, 3 of the years, all 4 years. What happens to your portfolio? And this is assuming that you start with $10,000 and then you're going through. So we have in the equal weight situation, we have where, okay, maybe in that year you sat out, you went all to cash. The second column is if you only put the stocks in cash. So you kept your bond portion, or in this case, maybe commodities and REITs. And then we're looking at the 4% annual withdrawal is what the WD means, all to cash. So this 4% annual withdrawal, this is to mimic if you're in retirement and you're taking annual withdrawals. So you need to pull from this portfolio over time. This is going to give you an idea what your $10,000 becomes in 25 years. with the withdrawals. And that's going to be similar for your 60/40 stocks and bonds and your 80/20 stocks and bonds. We're looking if you moved your stocks to bonds and if you had the withdrawals. So you can see as kind of a common theme here, if you just sat out one of these years, especially one of the early years, you have a big hit that you never recover from. You made a mistake in one year, and in this case, in the equal weight we'll look at here, your 48, what it should have been 48,000, ended up only being 38,000. So you cost yourself almost 20% of your portfolio 25 years later by thinking you needed to get out in a year and then you got back in too late the following year. And obviously this keeps going. If you sat all four of those times you sat out, your end result is you've lost almost half of what you would have had, which that's a sizable chunk. Let's look over here at maybe a 60/40 table, because this would be most common, let's say, for retirees. And we'll look at the 4% annual withdrawal. So you're starting at what would have been almost $16,000. So the 10,000 ended up with 16,000 after 25 years if you did nothing other than taking the withdrawals. And obviously this starts dropping down and you get to where if you sat out all 4 years, then you end up with less money than when you started, which obviously that's not ideal because you could have been at 16,000. But maybe one side note to offer on this, you still had almost your initial amount after making four mistakes in 4 of the years and taking withdrawals. So that shows even making some mistakes, sticking with the market in general is resilient. Your portfolio can handle a lot, even taking withdrawals out and making these mistakes. So just recap your sit out years. This is an example here. Bear market year of 2008, you're still in, you get out in 2009. So just keep in mind here, there's a lot you can hurt your portfolio easily, but it takes a lot to truly tank it all the way. You have a lot of ability to come through here. So let's go over some last important takeaways here. All right, so the winning investment categories in one period of time, there is absolutely no guarantee of them continuing dominance through the next one. Remember that example of emerging markets and US large cap stocks. We compare them from 2000 through 2009 and 2015 through 2024, completely different stories. And if you went all in on one and not the other, you're just kind of giving up on what diversity helps with there. The point of diversification and the periodic rebalancing, it's not to get higher returns. So don't confuse the goals here. There are two different goals we're trying to achieve. We want to maintain some returns for growth, but the purpose with the diversification between several asset categories and for rebalancing over time to keep them in that target, for example, a 60/40 mix, it's to keep a certain level of volatility because it's hard to get your cake and eat it too. You can't have maximum returns and zero volatility. What we want to find is the right balance that works for you as an individual or a couple that is acceptable, that, okay, I can handle X amount of volatility while getting a certain amount of return over time so that your portfolio can maintain or grow over the course of retirement. Lastly, neither you nor anyone else can efficiently time the market. Again, no one can. And even AI really should not be able to efficiently time the market because the market reacts like people do, which is unpredictable. Not only can you not time it, but you would have to get it right 2 times, right when to get out and then right when to get back in. When we had the big bear market in 2008 and 2009, it was around March of 2009, ended up being the low point. And I don't remember anyone saying, all right, today is the day you need to take all your cash and get back in. No one knew. And even then it drug out longer. So a lot of people just sat out and sat out. So I appreciate your time through this webinar. Hope that you've picked up a few nuggets of information, and just remember the takeaways about staying diversified, the purpose of rebalancing, and not expecting to just stick with the winners indefinitely and get rid of the losers. Stay well balanced and acknowledge that neither you nor anyone else are perfect for timing. Thank you.